Hello everyone, we are Group 9. The companies we have chosen to analyze are Hongtai and Volkswagen. This is our collaboration record. This is the context of our presentation. And this is YouTube link and the speech manuscripts. Today I will introduce the stock exchange of our two selected companies, Hongtai from Taiwan and Volkswagen from Germany. First, Hongtai is listed on the Taiwan Stock Exchange, and this main index is the TIRES. The TIRES include more than 900 listed companies, with a total market value of around 1.5 to 2 trillion US dollar. Taiwan's market is strongly influenced by the technology and semiconductor industries because Taiwan has an export-driven economy. The average daily trading value is approximately 200 to 400 billion NT dollars. On the other hand, Volkswagen is listed on the Frankfurt Stock Exchange, and the main index is the DAX. The DAX trades 40 major German companies and also commands the market capitalizations of around 1.5 to 2 trillion US dollars. Germany's stock market reflects its strong industrial and automotive economy. The average daily trading value is around 10 to 20 billion euros, showing high liquidity and strong global investor participation.
I am Jian Jieyu. Now I'll talk about stock introduction. First is Ferney Hetai. Hetai Motor was founded in 1947. It is Taiwan's leading distributor of Toyota and Lexus vehicles. The company has held number one market shares for 23 consecutive years. Currently, it is focusing on hybrid vehicles and expanding into MOX to maintain its leading position in the local market. The next one is firm B Volkswagen. Volkswagen, a German giant founded in 1937. It is one of the world's largest automakers, known for German engineering and iconic model like Golf. They are now shifting heavily toward the ID series to lead the global energy transition. So both companies are evolving from traditional car sellers into digital mobility providers, focusing on sustainability and smart technology. This is our data resource. Next, I'll talk about our initial portfolio. That is our investment assumption. Our analysis used April 2025 as the baseline period, specifically the first trading date of the month for Taiwan and Germany. This date is critical as it marks the month before the traffic announcement. Our monthly returns are calculated based on the closing price from the last trading date of February 2025 to ensure a consistent starting point for performance tracking. The portfolio is structured with a total investment of 120,000 NT dollars over a 1-year term. We used an equal weight strategy, allocating 50% to each asset. This is our target price analysis. First, let's look at Hetai Motor. On February 27th, 2025, the price was 620 TWD, and it's dropped to 611 TWD in April 2025. The most recent price in March 2026 is 502 TWD. And the next is Volkswagen's. The price falls from 104 Europe and 10 cents in February 2025 to 87 Europe and 50 cents by April. As of March 17th, 2026, it slightly recovered to 88 Europe and 8 cents. So to compare both companies, we use an exchange rate of 1 Europe is 36.65 TWD. In this way, both stocks could be evaluated on the same basis.
Now I'll talk about detailed investment allocation. The initial allocation strategy in our report is the equal weight strategy, which means we invest 50% in each company at the beginning. The advantage of this method is that it is simple and clear. It also allows us to compare the performance of the two companies under the same amount of investment money, making the comparison fair. The gain percent in the table can be understood as the percentage of price change. If the stock price increases, the gain percent will be positive. If the stock price decreases, the gain percent will be negative. For example, Hongtai Motor dropped from 620 to 611, which means the stock price decreases slightly, so the gain percent is a small negative number. Volkswagen dropped from 104.1 euro to 87.5 euro, which is a large decrease, so its gain percent is more negative. Okay. BHR return means buy and hold return retained. It shows how much value remains in the portfolio if investors buy the stock at the beginning and continue holding it until the end. So when the table shows total BHR return as $99,347, this number represents the final total asset value under the buy and hold strategy.
I'm Yu Zhichen. I will introduce the core financial institution of our report, Mega Bank. To explore the real impact of policy changes on the automotive industry, we must first understand the financial backbone supporting it. Looking at the key financial indicators from 2022 to 2024, Mega Bank reached a profitability peak in 2023, with its ROE hitting 12.96% and ROA at an outstanding 1.28%. In 2024, although ROE and ROA declined due to global market fluctuations, the equity multiplier rose to 12.15, showing that the bank flexibly managed financial leverage to sustain its operational strength. As of 2024, Mega Bank's total assets exceeded 4.16 trillion NT dollars, with a net income of over 28.3 billion NT dollars. This massive and stable financial capacity is precisely why it serves as the strongest backbone for the real economy. Now that we have seen the bank's financial strength, let's explore the real relationship between Mega Bank and Hongtai Motor. Mega Bank frankly helps Hongtai Motor groups and its companies by providing a lot of money for their daily operations and business support. As a clear example, on June 7, 2023, Hojin Enterprise, a company under Hotai's Ho Run Enterprise, signed a 10 billion NT dollar 3-year loan agreement led by Megabank. Notably, this loan includes green and sustainable rules. This shows Megabank's leadership in business finance, the deep trust from Hotai Motor Group, and how their partnership follows green policies to help with the future green transition.
In the money supply section, we mainly observe Taiwan's money supply condition, which means whether market liquidity is sufficient. The report shows that by the end of 2025, the M2 annual growth rate was about 5.2%, while the M1B annual growth rate was about 4.3%. M2 usually represents a broader definition of money supply, so M2 growth means overall market liquidity is still sufficient. However, because the M1B growth rate was lower than M2, it suggests that not all new money enter short-term trading or consumption. Some of money stay in saving or more conservative investment. The key point here is that although money in the market increased, there was no very aggressive consumption or speculative behavior. This means the market is currently in a loose liquidity but conservative spending situation.
Now let's look at Taiwan's current monetary policy operations and how the central bank is responding to structural inflation with precious liquidity control. First, the central bank has maintained its benchmark interest rate for 8 consecutive quarters under a higher for longer strategy. The discount rate remained at 2%. Since inflation is projected to be around 1.8%, the real interest rate has turned positive. These policies help reduce speculative borrowing and encourage investors in productive sectors such as AI infrastructure and advanced technology. Second, although interest rate remains stable, the bank is tightening liquidity through quantitative tightness. It issues negotiated certificates of deposit to absorb excess money from the banking system. At the same time, the bank keeps N2 money supply grow near the lower end of its target range to avoid overheating caused by Taiwan's strong AI-driven exports. Third, Taiwan faces strong capital inflow pressures because of its important role in the global AI supply chain. Therefore, the central bank is intervenes in the foreign exchange market to reduce excessive volatility, while allowing the Taiwan dollars to appreciate materially in order to control imported inflation. It also used the relations operation to prevent these interventions from increasing the domestic money supplies. Overall, the current policy stance can be described as restrictive neutrality, balancing inflation control, finance stability, and future economic uncertainty.
Beyond the company financing, macro policy is also key to the industry. In 2025, a big debate called the Big Mac War broke out. The economists accused Taiwan's central bank of keeping the exchange rate too low, making the new Taiwan dollar undervalued. They say this drove up housing prices and hurt purchasing power. In response, the central bank pushed back hard. They argued that using just one product, like the Big Mac index, to judge accuracy is not scientific. They also shared data from UNCTAD and OECD to prove that Taiwan dollar is not undervalued. This argument shows how international media and central banks see policies differently. Currently, Taiwan's central bank keeps a restrictive neutral stance, holding the discount rate at 2% to fight inflation. For the auto industry, this means borrowing costs will stay high, which tests every company's financial strength. Under this macroeconomic environment, domestic policies are very important to the market. This page covers the vehicle trend in subsidy policy. By scrapping an old car and buying a new one, consumers get a 50,000 NT dollars tax reduction. This policy successfully boosted market demand by shortening the car replacement cycle. For Hotai Motor, this was a massive help. In 2025, Hotai sold over 160,000 vehicles, reaching a 38.6% market share, a 16-year high. Hotai expects the total market to grow further to 440,000 units in 2026 as subsidies continue. However, policies also bring cost challenges. To protect the local industry, the government introduced the domestic localization policy. It requires certain cars to raise their local product rate from 15% to 35% by 2026. This puts pressure on Hotai Motor. Even though main models like the Corona Cross already use many local parts, the policy forces automakers to invest heavily in local supply chains, which drives up R&D and production costs. It also limits the speed of launching new affordable models, leading to longer delivery time or higher prices for some cars.
These are the clean vehicle tax credits provisioned under the IRA and their impacts on the automotive industry. The global automotive market is rapidly shifting toward electric vehicles because of carbon reduction policies and the clean energy goals. To accelerate this transition, the US government introduced the IRA to support domestic electric vehicle manufacturing and build a localized supply chain. Under the IRA, consumers can receive the tax credit of up to $7,500 when purchasing a new electric vehicle. However, vehicle must meet several important requirements. First, the final assembly of the vehicle must take place in North America. Second, a certain percentage of critical battery minerals must come from the US or countries with free trade agreement. Third, many battery components must also be manufactured or assembled in North America. These policies strongly affect companies such as Honda and Toyota. Toyota has expanded battery investment in US to provide electric vehicle production efficiency. At the same time, US subsidies increase global electric vehicle competition and may put pressure on Honda's pricing strategy in Taiwan. To reduce risk, Honda continues offering hybrid, plug-in hybrid, and battery electric vehicle to remain feasible in the charging market. In the future, electric vehicle supply chains may become more localized, creating one IRA-compliant system for North America and another for the rest of the world. Next, let's discuss the CBAM and its impacts on the automotive industry. CBAM is part of the European Union's Fit for 55 climate policy. Its purpose is to prevent carbon leakage by ensuring that imported products face the same carbon cost as goods produced within the EU. Under this mechanism, importers must report the carbon emissions embedded in their products and purchase CBAM certificates based on the EU carbon price. The transitional reporting phase began in 2023, while full financial implementation will begin in 2026. Currently, CBAM mainly targets carbon-intensive materials such as steel, aluminum, cement, fertilizers, hydrogen, and electricity. Since steel and aluminum are essential materials in vehicle manufacturing, the policy will significantly affect global automotive supply chain. For Honda, CBAM creates several challenges. First, higher carbon costs in manufacturing may increase procurement costs for Toyota and Lexus vehicles. Second, if more countries introduce similar green trade policies, exporting Taiwan-made vehicles could become more expensive. Third, investors are paying greater attention to carbon-related financial risks, which may affect Honda's ESG rating and financing cost. In response, Honda has strengthened supply chain transparency, promoted renewable energy use, and expanding low-carbon vehicle options such as hybrid and plug-in hybrid vehicles. In the future, carbon transparency and sustainable supply chains will become important competitive advantage in the global automotive industry.
Let's look at the prediction for her time model. Due to the rising oil price caused by the geopolitical conflict in the Middle East, Taiwan's economy is facing imported inflationary pressure. The central bank has pushed lending rate to 3.3%. On the bright side, the government's subsidy of 50,000 NT dollars for entry-level model like the Vio create a buy-now FOMO effect, providing much-needed support for sales. However, the localization ratio increase forced Haitai to switch to more expensive domestic supplier, raising production costs by 2%. Combined with falling consumers' confidence due to geopolitical conflicts, the overall market demand remains weak. Here is the breakdown of four calculation. So first, XT based on the price drop from February to April, we see a trend of minus 4.15%. Cost of funding, rising interest rate from both commercial and central banks adds a 5.018% cost burden. Policy benefit. Government subsidies and early purchase incentive provide a positive boost of 9.2%. Policy shock. New localization requirements and carbon tax create a 3.5% negative impact. And finally, ZT, decline consumer confidence and high fuel price contribute to a minus 30% impact. By combining these factors, our final estimate return for Haitai Motors is minus 60.468%. This suggests a challenging outlook due to the heavy pressure from internet rate and policy changes. Next, let's look at the prediction for Volkswagen. The European market is facing four major challenges. Decline global demands due to high interest rates, slowing EV demands despite subsidies, rising energy costs caused by war, and market uncertainty. However, Volkswagen's presence in China and North America helps reduce the impact of the European slowdown. Here is the breakdown of our calculation. First, XT. The stock showed a significant decline from February to April, resulting in a trend of minus 50.95%. Cost of funding. We used the central bank benchmark of 3.3%. Policy benefit and shock. We have assigned a 9.2% benefit and a 3.5% shock, mirroring broader industry impacts. The next one, ZT, for Volkswagen's, the external impact is estimated at minus 10%. After calculating these factors, the predicted return for Volkswagen's is minus 23.55%. This reflects a much steeper project decline compared to Haitai model, primarily due to the weaker initial market trend.
Scenario 1 is the baseline scenario. This scenario assumes that the market doesn't become extremely optimistic, pessimistic. Policies, interest rate, economic conditions, and external shock all remain relatively stable. Under this situation, it's become the reference point for other scenarios. If scenario 2 or scenario 3 is very different from the baseline scenario, it means external factors have a strong influence on stock prices. If the difference is small, it means the company's fundamental are the main factor. The report also shows that under the baseline scenario, the predicted price of Haitai Motor decreases, which means the market is conservative about the short-term performance. Scenario 2 is the global wealth effect and market optimistic scenario. When global stock market perform well and investors are willing to invest in risky assets, automobile stocks are usually supported because the market becomes more positive about consumption, investment, and economic growth. If global asset price rise, they quickly become loser and investor confidence improves. Large multinational automobile companies like Volkswagen are more likely to benefit from optimistic global market conditions. According to the poly market screenshot, the probability of the scenario about 32%, and the predicted stock price become 536.04 NT dollar per share. Scenario 3 is geopolitical shock and supply chain disruption. This situation usually increases the cost of energy, transportation, raw materials, and logistics, which then reduces the performance of the automobile industry. The report mentions that the probability of this scenario is about 38%. If it's situation happened, the automobile industry will face several pressures at the same time, such as rising oil prices, higher logistic costs, unstable component supply, and lower consumer willingness to buy cars. Under this scenario, the predicted stock price become 510.1439 NT$ per share.
Now, we turn to our final portfolio. These are the investment assumptions used in our analysis. First, we select April 7, 2025 as the benchmark date because it was the first market closing day after Trump announced his trade policies on April 2, 2025. The closing price on that day were used to calculate monthly return and evaluate the impact of policy change on the market. Second, the total investment amount for 1 year was set at 120,000 NT$. In our initial strategy, we all collect 60% of the investment and total Hong Kong and 40% to Volkswagen to achieve portfolio diversification. In addition, different expected return values, known as exchange values, were adjusted to each asset according to its exposures to policy risks and market conditions. Hong Kong was given a lower expected return because it faced greater geopolitical and trade-related uncertainty. On the other hand, Volkswagen received a higher expected return due to stronger market-driven growth and opportunities in the global electric vehicles industry. This chart shows our final investment allocations between Hong Kong and Volkswagen. Based on our portfolio strategy, 60% of the investment was allocated to Hong Kong, while 40% was allocated to Volkswagen. Out of our monthly investment budget of 10,000, we invest 6,000 in Hong Kong and 4,000 in Volkswagen. For Hong Kong, the share price decreased from 552 to around 502 NT$, resulting in a predicted return of minus 22.16%. In contrast, Volkswagen's share price increase generated a positive expected return of approximately 4.26%. Although Hong Kong experienced a larger decline in expected return, it still received a higher allocations because of its stronger market position in Taiwan and long-term growth potential in the automotive sector. On the other hand, Volkswagen provide international diversification and benefit from the growing European electric vehicle market. Overall, this portfolio aims to balance demonstrate market strength with global exposures while managing investment risk through the diversification. This chart presents the one-year investment performance of Hong Kong and Volkswagen from February 2025 to March 2026 under an optimistic recovery scenario. Using a predicted return from the previous slide, we calculate the total revenue and buy and hold return, as illustrated below. For Hong Kong, the projected return rate is minus 64.54%, with total revenue of 25,529 NT$ compared to a yearly investment cost of 72,000. In contrast, Volkswagen achieved a positive return of about 4.5%, generated revenue of 50,160 from a total investment cost of 48,000. Overall, the combined portfolios record a total return rate of minus 36.93%. However, after applying the BHR strategy, the return loss narrowed significantly to minus 7.27%. This result shows that long-term holding and diversified allocation can help reduce losing during volatile market conditions. The comparison also demonstrated that a mixed investment strategy provides better risk diversification. Even though one asset performed poorly, the stronger performance of Volkswagen helped stabilize the overall portfolio and reduce total investment risk.
Finally, I will present the overall summary and conclusion of our presentation. Our analysis can be summarized into 5 core findings. First, regarding the monetary and banking environment, while Taiwan's money supply aims to show stable growth, the central bank adopts a restrictive, neutral, and higher for longer policy framework. This means that borrowing costs for real industries will remain elevated in the long run. Second, in terms of portfolio analysis, facing this macro environment, we adjust our initial 50-50 allocation to an optimist strategy of 60% Honda Motor and 40% Volkswagen. The performance data proves that this mixed strategy provides better resilience than a single sector allocation. Third and fourth, through our quantitative forecasting model, we quantify the key risk factors. Although rising interest rates and policy shocks such as the 35% localization ratio and the EU CBAM created a 3.5% negative impact, Taiwan's vehicle replacement subsidy provided a powerful 9.2% policy benefit. These offsetting forces gave Honda Motor excellent defensive strength in our baseline scenario. Final, which leads to our conclusion. Amidst the high global economy uncertainty, scenario planning and risk diversification are paramount. Policy support and market shocks often offset each other, and the final returns will ultimately depend on geopolitical developments and the direction of central bank policies. The deep integration between Honda Motor and Megabank serves as a prime example of how industry and finance can unite to build resilience against the policy waves. That's all for our presentation today. Thank you for listening.